Welcome back to the channel. This week in crypto wasn't just about charts moving up and down. It was about policy, power, and liquidity, all shifting at once. Bitcoin spent most of the week grinding in a wide range after last week's all-time high. But the real fireworks arrived around Jerome Powell's Jackson Hole speech. A few dovish hints, and risk assets, crypto included, snapped higher into the close of the week. Ethereum outperformed on the day, majors turned green, and the market suddenly looked like it had been holding its breath and finally exhaled. That's the macro layer. Beneath it, three structural stories demanded attention. China edging toward yuan-backed stablecoins, the UK taking aim at Russia-linked crypto networks through sanctions, and a US policy turn that softens the stance on developers and money transmission charges. Add in ETF flows, an XRP legal closure with ETF chatter, and Solana's high beta spike, and you've got a week that tells you where this market wants to go next, with or without headlines. Markets first, because that sets the tone. Through midweek, Bitcoin kept finding buyers near the low 112,000 area and sellers close to last week's high-water marks, the classic pre-event coil. Then came Powell. His Jackson Hole remarks nudged expectations toward easier policy ahead. And that's exactly the cocktail risk assets like. Crypto jumped, Bitcoin pushed back toward the high teens of the 100,000s. Ethereum outperformed with a sharp two-digit pop intraday. And the high beta majors followed. Think Solana, XRP, Dogecoin. Lower rates, softer dollar, easier financial conditions. That is crypto's favorite backdrop, and the tape reflected it. What made the Powell move so punchy wasn't just the speech. It's the context. Coming into the week, the Fed-watching crowd had already tilted toward a near-term cut, and Jackson Hole was billed as the test. Odds on the CME gauges leaned toward easing, and when Powell gave markets just enough, the path of least resistance was up. In simple terms, if the cost of money is likely to fall, duration assets and risk go bid. Crypto behaves like a high-octane expression of that theme, and this week's reaction fit the playbook. Now, the macro story would have been enough for a typical week, but policy and geopolitics refused to sit quietly in the background. The UK sanctioned networks, it says, were helping Russia dodge restrictions. And crucially, those networks were tied to a ruble-pegged stablecoin known as A7A5. You don't need a law degree to see what that means. Stablecoin rails are now explicitly a sanctions battleground. When authorities put names on a list, liquidity can vanish in a heartbeat. Not just for the targets, but for any corridors that relied on them. The UK action arrived alongside similar US moves, and it landed like a signal flare. The era of treating stablecoins as neutral plumbing is over. The enforcement perimeter has moved right onto the pipes. At the same time, China moved the opposite kind of chess piece. Multiple reports say Beijing is seriously considering yuan-backed stablecoins to internationalize the renminbi and chip away at the dollar's dominance in crypto's base layer. If you remember nothing else from this roundup, remember this. Dollar stablecoins are the heartbeat of crypto liquidity today. If China blesses CNY-pegged stables in Hong Kong and Shanghai with real audits, clear redemption, and compliant banking, routing pairs and FX on-chain could look very different in a year. That doesn't flip a switch overnight, but it sets the stage for a multipolar liquidity world where USD is no longer the only game in town. Markets adapt quickly to incentives. If there's size, depth, and trust on a CNY rail, arbitrage will find it. And across the Atlantic, a quieter but meaningful policy turn. The US Department of Justice signaled it would back off aggressive money transmitter cases, the sort that blurred the line between writing code and running an unlicensed financial business. For builders, that matters. When the law draws sharper distinctions between code and custodial activity, innovation breathes easier, and capital that was parked on the sidelines takes a step forward. It doesn't mean a free-for-all. AML, sanctions, KYC, and consumer protection rules are still very much alive, but it does mean the enforcement posture is evolving towards something more precise. Zoom into the coins, because the character of this week's moves tells a story. Ethereum had the strongest impulse on the Powell pop. Part of that is simple beta, but part of it is ETF flows regaining their footing after a string of outflows earlier in the month. we saw a rebound in net inflows into spot Ether funds, with big names leading. Exactly the sort of flow that underpins genuine demand rather than short-covering pops. On top of that, the medium-term thesis around Ethereum as the rails for tokenized treasuries and real-world assets keeps getting louder, and when macro eases, that narrative attracts bigger, steadier capital. XRP had a different kind of catalyst: closure. The long legal saga with the SEC formally wrapped up this week, ending a cloud that's hung over the asset since 2020. With that door shut, something else opened. A cluster of amended XRP ETF filings hit the docket, a coordinated signal that product sponsors see daylight. If you're mapping flows for the next leg, that matters. A clean legal backdrop, plus potential ETF wrappers, can unlock whole new pockets of institutional demand that couldn't touch the asset before. Meanwhile, Solana reminded everyone why it's crypto's go-to high beta gauge. When the market's mood flips, Solana tends to overreact, to the upside and the downside. This week it was the upside. Headlines and commentary around network growth, ecosystem activity, and stablecoin scale on Solana fueled a push toward the low 200s, with momentum traders quickly piggybacking on Bitcoin's macro move. The debate about how far and how fast Solana can run into year-end is back on the table, and you could see it in options pricing and spot turnover all week. Step back and look at the stablecoin base layer. If you want a simple health check on crypto's pipes, watch outstanding supply. The USD stable market sits around $281 billion, a plateau that's acted like a springboard whenever policy winds turn favorable. With US legislation now codifying a playbook for permitted payment stablecoins, the Genius Act, and with Treasury officials openly talking about stables as a way to widen demand for T-bills, you can see why this foundation matters. Bigger, cleaner, better regulated pipes mean lower friction, tighter spreads, and faster capital rotation when the macro says, go. That US law, the Genius Act of 2025, deserves its own beat. The short version is that it lays down rules of the road for payment stablecoins: reserves, audits, liquidity, AML, the works. For years, the question was whether the US would try to legislate crypto out of existence or pull it into the tent. This week's news flow made it clear. Policy is shifting toward integration. The EU took notice too. Reports say Brussels is accelerating digital euro plans in part because it doesn't want the dollar to lock down a permanent head start in the tokenized cash race. Welcome to the part of the movie where central banks and treasuries are not background characters anymore. They're in the frame with the protocols. This week also gave us the corporates keep buying drumbeat. MicroStrategy, the standard bearer for balance sheet Bitcoin, added another few hundred coins. Small by its own standards, but big enough to remind everyone that the bid under the market isn't only ETFs and retail. When a listed company keeps scaling into volatility, it telegraphs confidence about the medium-term path, and it forces skeptics to keep remarking their models. Let's stitch these threads together. On the macro side, a more dovish Fed tone, combined with rising odds of cuts, refilled the risk punch bowl, and crypto drank. On the policy side, the UK's sanctions step made it crystal clear that stablecoin rails are part of geopolitical toolkits now. China's planning around CNY stablecoins hinted at a more multipolar future for on-chain money. And the DOJ signaled a narrower, more targeted enforcement environment for builders. On the market structure side, Ethereum ETF flows swung back. XRP cleared legal fog and saw ETF filings cluster. Solana did what Solana does when the lights turn green, and stablecoin supply held firm. The quiet rhythm section keeping time behind the solos. So what does the coming week demand you watch? First, follow through from Jackson Hole. If Fed speakers keep the dovish baton in the relay, dips will likely be shallow and aggressive buyers will keep stepping in. Second, Hong Kong and Shanghai. Any incremental detail around China's stablecoin plans will move mindshare, and eventually, liquidity. Third, the sanctions story. The UK move won't be the last. If you start to see coordinated actions or specific banks and desks adjusting their exposure, expect brief pockets of dislocation across pairs that rely on those rails. Fourth, ETF flows. Keep an eye on spot Ether funds and any formal updates around XRP ETF applications. In a market this headline-sensitive, products and wrappers are catalysts. Before we close, a quick reality check. None of this removes risk. If there's a single lesson from the last decade of crypto, it's that black swans don't send invites. Exchange failures, protocol exploits, policy surprises. They happen fast, and they don't care what your model says. But the direction of travel right now, from Powell's tone to product flows to policy scaffolding, is toward a market that is larger, better plumbed, and more integrated with the rest of global finance than it was even 6 months ago. That's the signal. The noise is the day-to-day chop. That's your roundup. If you made it this far, here's the question I want you to answer in the comments. Does the Powell hint plus the China stablecoin storyline put us on a glide path for a bigger move into September? Or do you think we chop until hard data forces the Fed's hand? Tell me where you stand, bullish or cautious, and why. If you're holding Bitcoin, Ethereum, XRP, or Solana, what's your plan into next week? Add, trim, or sit tight? Your takes help shape what we dig into next. We'll keep tracking the policy moves, the ETF tape, and the liquidity signals so you don't have to. Like and follow if this keeps you ahead of the curve, and we'll see you at the top.